Okay, hi everyone. This is going to be the problems for chapter 6. So we have some multiple choice, a few exercises, and then a large problem. So let's get started here looking at these. And let me change the highlighter to yellow. First one says if we have sales discounts with the terms 210 net 30, what does that mean? Right, so 210 net 30, right? So this means, right, here's our sale. If you pay within 10 days, right, you'll get a 2% discount. That's within the window, right? Outside of that, outside the window, up to 30 days, you got to pay us the remainder, right? So the idea with one here is it's going to be B, right? 210 net 30 means you get a 2% discount if you pay us in 10 days. Otherwise, the rest, the net amount, is going to be due in 30 days. All right, let's look here. 2, this one's a little complicated. Let's read the last part first. They want to know what our net sales are, right? So that's going to be our gross sales minus that CARD acronym gets us our net sales. Now, when we look at this, right, they're telling us gross sales are 300,000. Then they said half, right, 1/2 of those sales were credit, right? So 150 of these were on account, on credit, and 150 of these were cash sales, okay? Now they're saying there were returns, right, of 15,000, but they apply only to the credit sales, these guys right here, right? So 15 in returns. So that's going to get us 135 net credit sales, right? It's net of those returns. And then it said here sales discounts of 2%, right? So there must have been a 210 net 30 there, the equivalent of it. We're taking on net credit sales, these guys, not total sales, net credit sales there, right? So it looks like there was a 2% discount on that guy. Let me pull up my calculator here real quick, throw this in. We got 135,000 times 2%. We're looking at 2,700 of a discount. Okay. Finally, right, it says credit card sales of 100,000. We had to pay a 3% fee to Visa. Right, so 100,000 credit card sales, 3% fee we gotta pay. It's going to be 3,000 in credit card fees. All right, so what we're going to do here is we have our C, our credit card fees. We have our yellow for our returns of these 15. We have our green for any discounts, right, 2,700. And let's make our gross sales, let's do this light gray. All right, so if you did here your 300,000 minus the 3,000 minus the 15 minus the 2,700, when you do all that, it's going to come out to 279,300. C for number 2. So that one, you have to read carefully, right? That might be one that you have to pause, rewatch, but look at that one. It's a good one. All right, so it says here a company's been good, it's successful at reducing its returns, and then it also says it's reducing its credit card discounts as well. They want to know, how does this affect net sales? All right, well, the idea here is You have your gross sales minus that card acronym equals your net sales. They're saying here that they're reducing two items, right? If you lower two subtractions, you're going to increase your net sales, right? So the answer here is going to be B. By way of example, right? If it was like 10 minus 2, that equals 8. If you did 10 minus 1, that equals 9, right? This guy, the 2, if you lower it, it makes the answer go up, right? So lowering it makes it go up. And let's see here, I gotta get out of this. There we go. All right, it says a company using the allowance method, right? All right, so we know that's GAAP. They're gonna write off, right? So when they say write off, they're really saying step 2. $100,000 account receivable. Which of the following is or true? Okay, so we'll see step 1, step 2 later on. We've looked at it in the PowerPoint, but the journal entry for a write-off, right, in step 2 is going to be debit the allowance for doubtful accounts, credit the account receivable, right? So this is going to be minus asset. This is going to be contra asset minus equals asset plus, right? ADA is a contra account, right? It's kind of like net book value where you have the fixed asset, the equipment, the plant, minus the accumulated depreciation. So it has the opposite sign of whatever it's like the shadow account of. So the account, it's a contra account 2 is account receivable. In any event, right, when we're looking at this, all we have are 2 balance sheet accounts, right? No income statement effect. And when we look at this, right, we have plus asset, minus asset. Really, there's going to be no change in overall assets, right? They cancel each other out. It's like if you got 10 plus 2 minus 2, you're still at 10. So when we look at the answers over here, they say which of the following is true. Well, in this case, right, total stockholders' equity is going to remain the same. These are just balance sheet accounts, no income statement effect. Total assets are going to remain the same. We looked at that. And then total expenses are going to be the same, right? We didn't have any expenses in that journal entry. For this reason, the answer for 4 is going to be D, right? All of those are true. 1, 2, and 3. All right, so we have a company here, and they're determining bad debt expense using the aging method. Okay, so right under the allowance method, we have step 1, step 2. This one, we just looked at the journal entry, right? Debit, ADA, credit, account receivable. This one is going to be debit, bad debt expense, credit, ADA, the allowance for doubtful accounts. Here's the deal though, right? What numbers do you put in that journal entry? Well, there's this method A and method B, the percentage of credit sales, and the aging method. Here, they're using method B, right? The aging. And what happens here, right, when you use method B, we're going to have our allowance for doubtful accounts, the T account, and they're giving us some information, right? They're telling us from our aging, it looks like we found out the ending balance here is 250. We had a beginning balance of 220. Our write-offs were 180. Right here, we need to solve for our bad debt expense. Right, so when you would do the math on that, right, X would equal 210. C. Right, so this is under method B. Just to kind of, show you the other side of the coin here, if we use method A, what's the difference between them? Well, in that case, right, you'd have an allowance for doubtful accounts. You'd be given the beginning, amount. You'd be given the write-offs. You would then specifically figure out bad debt expense, 210. Then you'd have to solve for the ending, right? So you're under method A, you need to solve for the ending balance. Now, they're not going to be necessarily the same if you use method A and B. They could generate different results in there because you're using different techniques, right? It's kind of like if you wanted to average numbers and you did mean, median, and mode. All three are strategies you can use, but they'll give you different numbers. Similar here if you use method A or B. All right, let me erase this. All right, looks like we got a bank statement, right? And on that bank statement, it said there was an NSF check, right? There was a bad check. Which of the following would you do here to recon the bank statement? All right, so here's the idea, right? Here's you. Here's the bank. Let's say your grandma, right? Your grandma gives you a birthday check for $100, right? You get this check, you're all excited. You increase your books and records by $100. You take it to the bank, right? And the bank says, hey, that's a bad check, right? Grandma doesn't have the money in there to cash that. So you then get the bank statement and it says NSF check, right? Bad check. How do you resolve this? Right? Well, if you added it to your books and records, right, and it's a bad check, and then you learn that from the bank statement, you got to get rid of it, right? That gets you down to zero. The bank, they did nothing. They're at zero from it. That's how we resolve it, right? We would decrease our books, and on the bank statement, we don't have to do anything, right? We're just trying to get these equal to each other. All right, let's look at 7. It says, which of the following is not an effective control over cash? So requiring a signature from a manager and an officer on all checks. Oops. That one's going to be a good internal control. Require that we deposit the checks daily at the bank. That's a good one. Require persons who are removing cash from the register that they don't have access to the accounting records. Yeah, that's a good one. Answer here is going to be D for 7. Right? All of these are internal controls over cash. 8 here says when using the allowance method and the bad debt expense is recorded, in other words, step 1, debit bad debt expense, credit allowance for doubtful accounts, plus expense minus stockholders' equity, plus contra asset equals asset minus. In this case, right, if we look at the answers here, we have an asset that's going down and stockholders' equity that's going down. So the answer is going to be B, right? In this case, assets decrease, stockholders' equity decreases. All right, 9 here, it says, how would you present accounts receivable on the balance sheet, on the financial statements? This is going to be C, right? It's going to be your accounts receivable net of that allowance for doubtful accounts. Right, sorry, it's moving the drawing item here, but the answer for 9 is C. 10, which of the following is not a component of net sales? All right, so we got our gross sales minus that CARD acronym gives us our net sales. Returns and allowances, those are part of it. Discounts, that's part of it. Credit card fees, that's part of it. C, cost of goods sold, that's not part of net sales. Cost of goods sold is separate, right? When we have the income statement, the first line item you have is net sales, maybe $100. Then you back out your cost of goods sold and expense, maybe $30. That's going to get you your gross profit. But calculation of the net sales does not involve cost of goods sold. Yes, both are on the income statement, but they're separate items, right? Okay, so let's move on here to exercise 6.3. They're giving us some information. And what they want us to do here, right, it looks like we're looking at November and December. They want us to compute net sales for that period. All right, we said our net sales are going to be our gross sales minus the card, give us our net. Now, one of the things, we put the little asterisk in the PowerPoint, right? You have to do returns first, right? Even though it's card, C-A-R-D, whenever you calculate it, do the returns first. Okay, so with that, right, first thing we got to figure out here are our gross sales. Let's just make these blue. Right, so when we're analyzing these sentences, right, it looks like we made a sale for $5,500, for $400, and then $9,000. So $5,500, $400, plus $9,000. Our gross sales are going to be $14,900. Okay. Next, right, like I said down here, we got to do returns first. So let's back out any returns. So when we're looking through here, looks like we sold some items to customer D and then he returned one of the items. Okay, so we sold 10 items to him for $9,000. He returned one. All right, here's how we do this. One of the 10 items he bought, he's returning. He spent $9,000 in total. Right, so that means we're going to have returns of $900. He bought 10 for $9,000. One of them he returned. That means, you know, he got $900 back. All right, let's see what else we have here. I think we have some discounts. Right, those like 210, net 30 type things. Let's see if we can find any in here. All right, so we're doing discounts right now. And with this, right, when customer D bought it, it was 310, net 30. And then he paid December 6th. All right, so here's the deal. Right, he bought it on the 28th. But he paid in the 6th. This is in the discount window. Check, he gets it, right? You pay within 10 days, we'll give you a 3% discount. So here's the deal. Oh, we're really zooming in there. If he bought 10 originally, but he returned 1, so that means there's only 9 of the 10 he's going to get the discount on. Okay? And then it's going to be 9/10 times $9,000 times the 3% discount. Okay? Because if you do it in 10, you get a 3%. But it's only on 9/10 of it because he returned 1 of them. The math on that, right, you're going to get 243. Finally here, let's look and see if there's any, and let me make this guy yellow. Let's see if there's any credit card fees, right, any credit card fees. Oh, there, I'm seeing it, right? So we had some guy who spent $400, he swiped his credit card. We got to pay 2% of Visa. You do the math on that, it's going to be $8. Right, so we'll do the subtractions here. You have your gross sales minus the card acronym. Your net sales going to be 13,749. Now, one of the things here, you may look at this and say, wait a minute, right? What about this guy up here when we're looking at discounts? Customer B. He did pay us, right? He bought it for $5,500. We gave him some credit terms, and then it looks like he paid us. Here's the problem with it, though, right? He bought it November 20th. He paid December 20th, 30 days later. The discount, right? That's 310 net 30. If you pay within 10 days, you get the discount. He paid within 30, right? This is going to be outside the window, right? No discount. It's kind of almost like a coupon, right? If you've ever had a coupon and you were shopping at a store, it's only good for the next 2 weeks. If you use it then, right, you'll get the discount. If not, afterwards, it's expired. Discount's gone. So you got to be careful when you read these. We'll see as we move forward. Careful reading is important. All right, let's go to exercise 6.9 here. We have a company. Looks like they have credit sales of 1.3. They estimate 1% of bad debt expense. So they're using the allowance method, right? And we know that that's step 1. Step 2, it's going to be debit, bad debt expense, credit allowance for doubtful accounts, debit, allowance for doubtful accounts, credit account receivable. Okay, so in this case, right, the numbers, A and B, they're picking A, percentage of credit sales. In other words, they're saying 1% of our credit sales is our bad debt expense, or 13,000. Right, so we can plug that in here, 13,000. That'll take care of that requirement. Then it says in the current year, right, we wrote off 4,000 of the amount, right? So we'll put 4,000 in for that guy, right? This is just showing us the allowance method. The journal entries, one of the ways you would calculate it. All right, next one here. These last 2 problems are complicated, so you may have to pause and rewatch them. So a couple things, right? We're looking at this as a starting point. We have a bank statement that has an ending balance of $57.70. Likewise, we have our books, right? And when we look at that, our T account in the books, we have our beginning plus our additions minus our subtractions. Our ending cash on the books is going to be $5,700. That's the starting point here, okay? So here's the deal, right? You're the accountant, and I come up to you and I say, hey, why are these different, right? Did you screw up? What's going on with this? And you would say to me, no, I didn't screw up. We just have a difference here that we need to account for. In other words, we need to reconcile the bank statement with our cash account. Right? Doesn't mean I did anything wrong. It doesn't mean the bank did anything wrong. We need to just, gel these together, adjust them in light of the other's point of view to show and reconcile any discrepancies. Okay, well then I'd say to you, can you show me that? Can you do the bank recon? First thing you would do, right, when you were doing the bank recon is you would say, hey, look, when we look at that bank statement, there was a $60 fee. Right, on the bank, they took out $60. I didn't know about this. None of us here knew about this until we actually got the bank statement. Right, so if they subtracted $60 on the bank statement, we need to subtract $60 on our books and records. Right, that's how we would kind of cancel that out or explain the difference here. Right, so with the bank recon, right, we're going to have some additions, some subtractions to the books, some additions, some subtractions to the bank. That's going to get us a corrected ending balance. So in this case, right, because they subtracted it on the bank, but we didn't subtract it on the books, we got to do that here. Right, so we got to subtract out the bank fee of $60. That's the first thing, right? When I was looking at this and I was like, trying to explain to you what was going on. Next thing I would look at, right, is I would say, hey, I'm analyzing this bank statement. There was a bad check, right? Grandma gave us a bad check. And if you remember, right, when we just did the bad check, what happened here is when we got the check, how much was that for? $170, right? We increased our books down there for it, right? But the bank, they said, no, that's a bad check, right? They didn't do anything with it. So now here we are in our books, right? This is wrong. We wouldn't include this 170 in there. It's a bad check. How we reverse it, subtract it out. Right? NSF check 170. NSF means non-sufficient funds. Bad check. Okay? Next thing I would look at if I was trying to explain this, right? I would say, it looks like over here on our books, right, we had, in this case, deposits of $28,100. However, right, the bank statement is only recording deposits of $26,900. Right, what's going on with this? There's a difference here of $1,200. These are going to be deposits in transit. Let me explain what that is. All right, so here you are, right? You have a check. You put it into the bank, right? Now, if you've ever deposited money into a bank, right, it may take up to 3 days for that to clear. Right? Imagine then on day 2, the bank created the bank statement. So what has happened, right? You increased your books and records. You thought you had this good check, you deposited it. It clears over here, but the bank statement is then. Right? So because you included it, but the bank didn't when they issued their bank statement, we need to include it over there. Right? That's how we reconcile this difference. And in this case, right, it looks like we deposited 28.1. The bank only cleared 26.9. That means we have 1,200 that are waiting to clear. They're like jammed up, right? So in this case, how we reverse it is we add the deposits in transit of $1,200. All right, next thing I would look at, right, to explain these, and say, look, we wrote 28.9 in checks. However, the bank only cleared 27.4. Right? In that case, there's a difference between those two of 1,500. What that's going to be are outstanding checks. So let me explain to you what that means. So that situation was deposit in transit. This one's an outstanding check. Right, so here you are. Right, you go to a wedding, you give $100 check to the people getting married. Right? Now in this case, you've subtracted $100 from our books and records. Right? And let's imagine these people, right, they get your check, that's great, and then they go off on their honeymoon to Hawaii. Right? That's like a bad picture of Hawaii. It's a bunch of little islands, and then you have Oahu, which is like the big, well actually there's the big island and then there's Oahu. Don't worry about it, but here's the idea, right? They're on their vacation, blah, blah, blah. They cash the check like a month later, right? 30 days later. That's when they cash it in. But the bank, right, maybe here when they're on their honeymoon still in Oahu, they issue the bank statement. Right, so here's the problem, right? We wrote a check. We reduced it. It's floating out there. They haven't cashed it. The bank doesn't know about this. How we reconcile this, right? We got to subtract it from the bank. That makes things, reconcile. So in this case, right, we wrote 28.9 in checks. The bank cleared 27.4. That means there must be 1,500 of checks that we wrote that are floating out there, right? We're waiting for the people to cash them. Right, $1,500. This guy is going to be not applicable. It's pretty much all of the reconciling we need to do. So if we look at this, right, we have our beginning plus 0 minus 60 minus 170. It's going to give you 5470. Okay? Over here, right, we have 5770 plus the 1200 minus the 1500. It's also going to give you 5470, right? They match. Now, we went from being different up here, right? 5700, 5770. To being the same down here. Right, so different, same. So maybe I'll, put a smiley or something there and then a frowny there, right? They're not the same. So that's the idea with a bank statement. Essentially, you have different amounts to begin with. You have to reconcile for it, and that gets you a corrected ending balance. Now, one of the things, right, with this, they have some follow-up questions we can look at here. They're saying, giving the journal entries that result from it. Okay, so anytime we started messing with cash, right, over here in our books, we need to update our books and records for it, right? So the one was the bank fee, right? I think that was like the first one we identified. In this case, we're going to debit. We can put bank fee, expense. It doesn't really matter. Just an expense, credit, cash, right? $60. We got to take our cash down, reduce it. The other one was for that NSF check, right? The bad one from Grandma. She wrote us the bad check. We know from there we're crediting cash for $170. But in this case, right, we don't know if Grandma did this intentionally. Let's hope Grandma's like a good grandma or something, right? She's not trying to yank our chain here or, in other words, this wasn't like a bad debt expense, right? Grandma isn't our customer. So what we're going to just do to kind of play nice here, we're going to do debit account receivable Grandma, right? $170. We're going to give her the chance to pay us back. We'll just treat it like a receivable, give her the benefit of the doubt. 3, it says, what balance should be in cash after the recons? Well, that's $54.70. And then 4 here, what total amount of cash should be on the balance sheet? $54.70. Right from over there. All right, let's look at problem 6.1 here. All right, so first thing I want you to do, if you haven't done this already, is you got to build out this chart. If you're taking these notes by hand, you can draw it, write it out. If you're doing Excel, build it out. If you're doing neither, right, if you're just watching this, you're probably laughing right now saying, oh, he caught me, I'm just watching. That's fine. Just make sure you watch, right? You understand what's going on. If you want to follow along, great. If you just want to watch, fine too. But you got to build out this chart and understand in this problem that we're populating it. So here's the deal, right? This problem is tricky. So it might be something you have to watch multiple times. I'll do my best to unpack this slowly and carefully, but it's inherently tricky. All right, first thing we're going to do to make our lives easier here, so let's just kind of identify some of the usual suspects down here. We got a bunch of people we're dealing with, clients, right? R. Smith, so every time we see him, let's make him blue. Likewise, right? We got this K. Miller guy. Every time we see him, let's make him green. Then I think we got a couple randos here. Let's B. Sears. And this R. Roy. I think that's everybody. Right? That's the first thing we're going to do to make our lives easier. Now let's look at the prompt, right? Assuming you've created the chart, you've done some of the highlighting. Let's see what's going on here. They're giving us some information. Here's the beginning of the year balances for accounts receivable and allowance for doubtful accounts. They said in the following order, except for cash sales, anything sold on account was credit terms 210 net 30. Right? So if you have it on account, we're going to offer that discount unless it's cash. It also says each unit we sell was $500. Right? So $500 per unit sales price. Okay? So we're going to go through here and analyze this A through M. We're going to populate this chart, which is basically an income statement. And then afterwards, we're going to produce an income statement. So first one here, right, it looks like we sold merchandise for cash. Right, so cash is important here of $235. Right, so we do debit, cash, credit revenue, $235. Go over here, right, we'll populate that guy, $235. I'm going to put a cash mark there. I'm going to put cash there as well, just to signify it, because that one's kind of special. Not many of them are cash. All right, that's great. Not too hard there. We just did A. Let's look at B, right? We got our first encounter with R. Smith. He's going to be a repeat customer here. So we sold some merchandise to him for $11,500. So if it doesn't say cash, we have to assume on account, right? So debit, account receivable, credit revenue. In this case, right, it was $11,500. And this guy was $235,000. I guess I'll write them all out. All right. Not too bad there for B. We can cross it out. Next thing, K. Miller comes in. He's our next friend, right? He buys stuff on account, $26,500. Right, $26,500. Not too bad. All right, R. Smith. Oh no, we got to see you again. This R. Smith, it will be causing us some headaches. It looks like 2 days after the purchase, he comes in and he returns one of the units. Right, so the idea here is if each unit we sell for $500, one return equals $500. Right, so for this one, for D, we're going to populate $500 in there. Okay, that wasn't too bad. Sold merchandise to B. Sears for $24,000. Okay, in E here, we're just populate the $24,000 for E. Sears. Man, R. Smith, why are you coming back? Right, we got to deal with him again here. R. Smith, now he paid his account in full within the window. Okay, all right, so let's draw R. Smith over here. So here's the deal, right? He buys $11,500 worth of stuff. That's the starting point, right? Then he returns one item, right? $500. So that means he has really like $11,000 he purchased from us. We go over here, they're saying he paid within the discount period. In other words, he's taking us up on this 2% discount. Right, but we're not going to give them to him for the full amount. He returned 500 of it. Right, so we got to do 2% times 11,000. Looks like that's going to be 220, right? It's going to be the discount for R. Smith. And that was F. Right, so we can put 220 in there. All those blue things are R. Smith, and I think that's our last time dealing with them, but we're going to have another K. Miller fun. He's going to be giving us some trouble here, K. Miller. Oh, the characters in accounting, right? Next one here, it says collected $98,000 in cash from customer sales on credit in the prior year. It was within the discount period, right? So they got the discount. Here's the deal with this one. This one's kind of tricky. You got to think about this. Right? We have the prior year and then we have the current year. Last year we made a sale on account, right? This year they gave us the cash for 98, okay? But here's the deal though, right? The amount of cash they gave us was after applying the discount. In other words, right, we made a sale for a bigger amount. They took the discount, 2%, and they paid 98. So the idea with this is, right, this sale over here, if they paid 98 and they got a 2% discount, that must mean the sale was for 100,000. They got a $2,000 discount, right? And they paid us 98 because they paid within the window. Bought it, paid within the window, got a discount. Now, with this, right, you could figure out, I just gave you the 100. You know, you could figure that out. It would be 98,000 times, I'm sorry, let me erase that, it's divided by 1 minus 0.02 equals 100, right? And if you have 100 and you know that, you can back into the discount. I'm not going to test this scenario on the exam, it's tricky, but the idea here is you just have to be aware that they pay less than the full amount if they take it in the discount period. So we said there was a $2,000 discount there, and that was in G, right? $2,000 discount. All right, we got our friend K Miller again, right? It looks like he paid this invoice of $26,500 up here in the discount period, right? So here's the idea with this, right? $26,500 times the 2% discount he's getting. Do the math on that, 2%. We're looking at $530 of discount. Oh. So the idea is, right, he bought it, paid in the window, he gets a $530 discount. He was green, right? Let's find that original sales at 26.5. Right, that's just mapping out the K Miller guy. All right, next one here, sold merchandise to R. Roy, 19,000. Nothing really to write home about there. 19,000. Can call it a day on that one. All right, 3 days after paying the account, man, K Miller, man, why you gotta come back here, right? I wanted to be done with you. Why do I gotta see you again? 3 days after paying the account in full, K Miller returned 7 units, right, and received a refund. Okay, so there's 2 things we gotta account for here, right? The return of 7 units. Okay, we said each unit is $500. Means we got a return of 3,500. Let's plug that in, take care of that first, and then we'll talk about the thing that's a little bit more tricky here. Right, so our returns, 3,500, our good old dear friend K Miller. Here's the problem, right? This is where it gets tricky and you got to think about it. So if we go back up here, we sold some stuff to him. Okay, he paid within the window and he got all of the discount for all of the stuff we sold to him. However, right, then he returned some of the stuff. Right? You notice the problem here? Here's the deal, right? The discount he got was for all of it, but he returned some of it. Right? We need to update the discount. Right? We need to claw some of that back. It's like those, if you ever saw those YouTube videos where they'll like show you people who are trying to like pay cash at a cash register, and they'll like trick the cash guy to give him money back, and like more than he had, like sleight of hand items. That's what this K Miller guy is trying to do. We need to catch him here. Right, so he returned $3,500 worth of stuff, right? We got to claw back that 2% discount, right? That's going to be $70 discount we got to take back. Right, so over here, we're going to do negative 70. Right, the idea is you get 530, then we do minus 70 there to really reflect the discount he got on the net items he purchased, just what he kept, right? At least we're done with him now. Bam. See ya, K Miller. You're gone. All right, after the discount period, let me do this. It says after the discount period, so that means in this case, no discount, right? We're outside the window. $6,000 was collected on account from a prior year sale. Right, so we do debit cash, credit account receivable. These are balance sheet only accounts. Right, no effect on the income statement. So K here is going to be blank all the way through. No impact on the chart for K. L says we wrote off a prior year account of $3,000. Okay, so that's going to be step 2. We're going to debit the allowance for doubtful accounts, credit the account receivable for, what's it saying here, $3,000. Here's the deal though. These are balance sheet only. Again, just like that guy. Right? Accordingly, for L, no effect on that. All right. The last part, M. This is tricky, so pay attention here. They're trying to figure out their bad debt expense, and they're saying what it is. It's 1.5% of credit sales net of returns. All right, so what they're saying here is, first off, you got to get your credit sales. You got to back out any returns, and that's going to equal your credit sales net of returns. And they said 1.5% of that amount is going to equal your bad debt expense. Okay? So we got to figure out these things up here. First thing, let's try to figure out our credit sales. So I'll make these pink there. If we go up, right, our credit sales are going to be all these guys up here, except, right, that guy, that's cash. The 235 is cash, so we're not going to include that. But the 11.5, the 26.5, the 24, and the 19, If you add those together, right, you're going to get 81,000, right? That's going to be 11.5 plus 26.5 plus 24 plus 19, right? The pink's up there. Our returns, right, we're looking at 4,000 from up there, right? 3.5 plus 5. Okay, so if we subtract it to get our credit sales net of returns, in that case, we're going to be looking at 77,000. Okay, so we have our credit sales net of returns, and we're saying 1.5% of that, namely 1155, is going to be our bad debt expense. All right, so we can populate that in here, 1155 in the bad debt expense column. Okay, so let me take a second, pause, look at that if you need to see it. I'm going to erase it. All right, next thing we got to do is total all these guys. Right, when I say all of them, I mean literally all of them. Include the cash in this, right? You're going to foot them, the entire column. When you do that, right, you're going to get 316,000 in sales, 2680 in discounts, 4,000 in returns, and 1155 in bad debt expense. We're going to use this information to prepare an income statement, right? So first line item on our income statement are net sales. But we got to do our gross sales of 316,000 in this case. Sorry. We're going to have to back out, right, so we can put a check there, our returns of, let's see here, 4,000, right? You do returns first. We're going to have to back out the discounts of 2680 from up there. That's going to get us our net sales of 309, 320. Carry that over to the income statement. The only expense we got to back out is our bad debt expense of 11. That should be 55. So if we take 309, 320 minus the 1155, looks like our net income here is going to be 308, 165. Now, obviously, right, like a full income statement would have other expenses and items like that. But like I said, the problems for this chapter were a little bit more difficult. If you watch this once, right, you're saying, I got most of it, but there's a few items that I'm a little bit unsure about. Watch it again, right? Feel free to pause it, rewind. It's like the beauty of doing this in a video. You can watch and rewatch. It's not like live in class where if you miss it, you're going to miss it, right? So that's why I try to balance keeping the videos to like a reasonable time versus flying through things unbelievably fast. So just pause. If you want to run the math through a calculator, go ahead. That's fine. But with that, we're going to end the video here, and we'll see you guys in the next chapter.